Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are going to look at something a little bit out there today. We have some interesting economic data on the calendar outside of the US, and we are going to use that as an opportunity. We are, of course, traders, so opportunism is in the DNA. And so we are going to take this as an opportunity to talk about the Australian dollar. And the reason we're going to really focus in here is because this exchange rate is so tied into where market sentiment overall sits, where investors' thinking lies well outside of Australia or outside of the catalysts impacting Australia or outside even of the major forces into which Australia falls thematically in the global economic story. This currency is so thoroughly embedded into overall sentiment that it becomes an excellent indicator for overall market mood writ large, and of course, U.S. stocks as a reflection of that, and really stocks in general. So let's first get an anchoring in the economic data. So this is what is coming out here today. So obviously this is the 1st of March. It's the 28th still in the U.S., but time zone wise, it's about to be the 1st of March morning in Australia and indeed in the APAC region. So this is this evening U.S. hours. We're expecting to see a slowdown in GDP from 5.9 to 2.7% on the year-on-year rate. We are also getting a round of PMI numbers out of China. This is Australia relevant directly. China is Australia's largest export market. It is also the largest buyer of almost all commodities, almost every commodity, not just Australian. And that, of course, is a larger thematic thing. Australia is a country powered primarily by commodity exports, by its mining sector, and then the financial sector servicing that mining sector. If you look at the makeup of Australia's own stock average, the ASX, you see that it is about 20%, give or take, miners, 30%, give or take, banks. So overwhelmingly, the capitalization of Australia's stock market is miners and banks. Overwhelmingly, the economy is miners and banks in terms of what really contributes to the lion's share. And so Australia then falls not just into a direct sort of relationship where China is their biggest export market, but as there are trends in the narrative of commodity producers facing demand from their main export markets, demand for inputs of global production in general, which of course commodities are, and demand from those markets that then consume the finished goods of which commodities are made up, or which are made up of these inputs. All of that speaks directly to the Australian dollar, and of course, all of that makes it a poster child for this relationship where China takes in raw materials from much of the world, produces finished goods, sells those finished goods elsewhere, or at least does a big part of the intermediate goods production. We, of course, have global supply chains where intermediate goods are made in 5-6 locations, perhaps, before you get from raw materials to finished iPhone, as it were. You nevertheless still have a very big part of this that's China. So, of course, there's a very strong bilateral relationship between Australia and China economically, but also it is a relationship that tells a broader story. And so really the Australian dollar sensitivity here is manyfold. to this Chinese data directly, thematically, and so forth. So we're going to look at what this shapes up to be, and then we're going to see the Australian dollar response and how that tells us where stock markets are headed. So let's begin with addressing Australia's economy. As we said, we're expecting a slowdown in the fourth quarter. That would be consistent with what we are seeing in the activity survey data. So there, right there, is the marker you see for Australia Industry Group's version of PMIs. This is essentially the same thing, a set of diffusion indexes that works with a center at 50. Above 50 is expansion, below 50 is contraction, 50 is neutral. The further you go above, the faster the expansion, the further you go below, the faster the contraction. You can see the extreme case of a sharp contraction there in the first half of 2020 on the chart. That's that big dip into the vicinity of 30, 35 on the indexes. That's sharp contraction. And of course, that's COVID. So what you're seeing now here from September 2022 onward is obviously deepening contraction at a faster rate. So you can see these indexes are well under 50 and trending down. So not surprising then that we should be expecting to see weakness. Now, these surveys are a little bit lagged. They don't show the entire fourth quarter. So let's consider another set. This is an analogous set of PMIs. This one is from S&P Global, so the usual purveyor of PMIs. And here you see the composite index still in contractionary territory, so under 50. The actual sectors here showing you that manufacturing is basically at standstill. It's essentially at 50, and services are still under. So there's been a little bit of a pickup in services, and you can see that's been the main driver of this going over the past several months. But the economy is still looking very, very weak, and you can see that the slip under 50, in particular for services, and the composite index occurs in the fourth quarter of last year and really becomes acute there. So it's exactly the kind of thing that would be consistent with a slowdown in GDP. Furthermore, about 30% of Australian CPI is housing, a little bit more, 33-ish, give or take. If we then look at the populations centers, Sydney and Melbourne, where most Australians live, and you consider what the house prices there have been doing. So you look at the average of Sydney and Melbourne, you look at it year on year, and you overlay it with CPI, you have to give it about a 5-quarter lag because housing, of course, moves relatively slowly, but also because changes in housing are relatively slow to show up elsewhere. So there's about a 5-quarter lag, it seems, between where overall CPI's turning points are and the year-on-year housing price index that we've constructed here out of Melbourne and Sydney. And what you see is it's quite possible that inflation has peaked already. If this is a relationship that continues to hold at least at the turning points, then perhaps you've already seen a big enough downturn in housing that CPI is going to start to come unraveled. So you have slowing growth, a shrinking economy, and you have CPI that maybe is topping already. Yet, you've had a significantly hawkish shift in the expected policy curve from the RBA since the last policy announcement. That was at the beginning of this month. Since then, you can see the curve has shifted meaningfully higher, in particular for the 6-month to 1-year zone. So it looks like we're going to get many more rate hikes, and we're going to peak later than we thought, even just at the beginning of this month. And that's in many ways linked with the very hawkish rhetoric that we've gotten out of the RBA, where the markets thought they were effectively getting ready to be done here. And the rhetoric has really been, no, that's not at all what's going on. We are not ready to be done. We think inflation needs more of a fight, and we're going to keep going. So even as the economy has slowed, even as inflation might be peaking, you have an RBA that's been sounding relatively hawkish, and the markets have clearly responded. So what happens then if you get a soft GDP number, perhaps an even softer one than is expected, which is kind of how this is shaping up? And then you end up with a situation where this upshift looks wrong. So let's take a look at what that upshift looks like in practical terms, in terms of incoming policy announcements. We can see here that at this point, we almost have a full rate hike baked in for the beginning of March. We're 81% of the way there. We certainly have one already baked in, at least a 25 basis point one, and maybe about 85% chance of another at the April meeting. So you can see we're 42 basis points for the implied rate delta by April, which means we've had at least one 25 basis point hike. Once we get to May, we're at 58, 59 basis points. So between those three meetings, we've raised rates twice. As we get into July, you can see we're north of 75. We're at 80, 81. So there, we've raised rates three times by July. And then as we get later into the year, you can see we don't quite make it all the way to having a full 1 percentage point baked in. We sort of top out around 92, 93 basis points, and then we seem to turn. So it seems like by the end of the year, and if you look at the number of hikes or cuts column on the left there, one in from the left, you can see we're at 3.6, which means that we get 75 basis points in hikes and a 60%, almost 61% chance that we are going to have four, that we're going to have a full percentage point in further hikes. Australia's economic data has tended to surprise on the downside, though. And you can see it's accelerated in that direction recently. So you're in a situation where, and this is very importantly, this is surprising on economic data, not the period for the economic data itself, which you can see here, the index actually looked like it was above zero for a good bit there in the fourth quarter, but that's the data that came out at that time, not that time in data, essentially, right? That's not data for that period. It's data that was released at that time. And economic data is, of course, lagged. So here we are looking at the fourth quarter GDP number now, whereas that fourth quarter ended 2 months ago. So you can see that as we get data from around that period of time, disappointment has crept back in. End of January and around now, through the month that we're just wrapping up here. So this would suggest, again, that the economy has turned out weaker than economists expected, which increases the possibility that we're going to get some kind of an adverse shock on this GDP number. If we get that adverse shock, well, then this looks wrong. This looks like it maybe is a little rich and needs to shift back down. That would undermine yields-based support for the Australian dollar and should be perhaps some sort of a source of weakness. Nevertheless, we have been getting negative economic data. We have been seeing these PMI numbers show weakness. Nevertheless, we have had this hawkish shift. So the markets seem content that the RBA is going to be more aggressive in their rate hike cycle. Again, perhaps another whole percentage left here between now and the end of the year, maybe 75 basis points. That's quite a bit of tightening still in the tank. This should be something that's Australian dollar supportive. Hold that thought as we look at the Chinese data. So here are expectations for what we are looking at today. We're going to have CFLP, manufacturing and service sector PMIs. That's the Chinese Federation of Logistics and Purchasing, if memory serves. And that's the government's vehicle for making PMIs, so these are official data. And then we have Caixin Manufacturing PMI, which is produced by S&P Global, and it's a private sector estimate. Generally speaking, the CFLP one tends to be more about big state-owned enterprises in China, so large firms, oftentimes with a part owner or a majority owner being the government itself. And the Caixin numbers tend to be smaller firms with a little bit more of a private ownership, as private as it gets in China, kind of character. What you see here, actually, for both of the manufacturing indexes, is relatively analogous. So you see a return to modest growth, and modest really should be underscored here because it really is very, very modest. The expectation is that on the Caixin one, we're going to come out of contractionary territory just by a hair to 50.7. For the baseline one, we're going to go from 50.2 to 50.6. So again, we're really scraping that neutral line here. We're getting a little bit of positive growth from these expectations. Services, of course, has had a very brisk run already, but services, as you can see here, is a very volatile index. So it can contract quickly and expand quickly, especially in the recent period. So we have had a very spirited rise in the prior month. It looks like we're going to nudge up a little bit more to 54.9. But in the grand scheme of the service sector, this is not unusual volatility. You can see really since the beginning of this year, it's had very significant swings, and all of last year, very significant swings. So I'm not necessarily looking at that and saying, oh, this is terribly encouraging, or terribly discouraging for that matter when it swings down hard. What we do see, though, is the world's largest economy reopening, second largest economy reopening by leaps and bounds here. So essentially saying over the course of a month, we had these COVID lockdowns, we're going to pivot 180 degrees on them and just scrap everything and just let everything go. And needless to say, there's been a lot of optimism around this is going to be a source of growth. Now, it's been slower coming, but if we look at the way that that Chinese economic data has performed relative to those expectations, that surprise index, we can see a very brisk pickup here over the recent weeks. This should be very encouraging. This should be a sign that indeed a Chinese reopening benefit is starting to be felt. It's very modest here in these PMIs, though. Comparatively speaking, when the U.S. was opening from its lockdowns, we were looking at dramatic surges in PMIs, not hugging the 50 line, but jumps into the 60s to show a really very quick acceleration in growth. Because recall, above 50 is growth, but the distance above is speed. And when you're doing a catch-up reopening of the economy and suddenly you were basically not moving and you're now moving, you've taken the restrictions away, the pace of expansion tends to really accelerate. That's not what we are seeing here in these expectations. So there is perhaps a bit of a risk to the upside for these numbers. One indicator that we've been looking at is metro traffic in the top 5 cities in China as a kind of activity indicator, because of course Beijing has stopped reporting case numbers and it's very difficult to tell where in fact we are going to have a peak in cases, the recovery really gains steam. This is a sort of proxy indicator for people getting out there and re-engaging with the reopened economy. And in fact, there it is, in front of you, an absolute surge in metro activity to levels we haven't seen really since the onset of COVID. So back to levels approximating the peak in the recovery before the lockdowns really stung again for the next wave, and of course approximating levels before the big drop in 2019. So we're looking at a situation here where indeed the Chinese reopening appears to be gaining steam. The thing that's a little bit different here, though, and this is something that we've been looking at as an indicator for quite some time, is it's not really enthusing markets. There was a lot made about this China reopening being a big bullish story for markets, and we've talked about how that doesn't seem to line up. Of course, Chinese stocks have been up a lot since the beginning of the year and late last year, but that's largely started to happen before the reopening. That started in November, largely around the idea that the Fed was telegraphing the end of the rate hike cycle, which, of course, over the course of February has been re-examined thoroughly. But here, now that the economic data seems to actually suggest that reopening may be getting a bit more momentum in China, now that the evidence seems to be starting to come in, what's not occurring is a pickup in capital flows along the critical Shanghai-Hong Kong stock connect that allows people with access to Shanghai to trade directly in Hong Kong, so creates a conduit for the pent-up demand of locked-down Chinese investors to deploy capital abroad, and vice versa, allows for those with access to Hong Kong markets, most notably international investors, to buy on the Shanghai exchange directly. And so to have money coming in to catch this reopening and capitalize on the revitalization of this crucial economy. That's not occurring. The trend has been down in total turnover. And so, interestingly, we do not see investors putting their money where their mouth is, seemingly. I will note that the peak in turnover occurs around middle of 2021. Remember when the Fed began to set the stage for this tightening cycle. It was the middle of 2021. It was at the June FOMC of that year. That's where the transitory inflation narrative was essentially retired. And the Fed said, look, we're going to have to tighten, and we're going to have to do it with some vigor here. The tightening, of course, didn't actually begin until the subsequent year, around March. But the stage began to be set. Rates began to adjust in markets in anticipation. Risk sentiment began to adjust in markets in anticipation. And so what we are seeing here is very interesting because, again, one would think there is optimism here, but investors are not trading it that way, or at least capital does not seem to be flowing as though that were the case. Instead, there seems to be a kind of drift lower, and it seems to begin at the time that risk appetite began to sour everywhere. Which brings us to the critical chart in this entire discussion. In the red line here is an average value of the Australian dollar. Critically, this is not the US-based, the US dollar-based futures. So this is not just the Australian dollar getting weaker because the US dollar is getting stronger. The rising lines there, the orange and the dark bluish grayish there, that's expectations for Fed rate hikes at the July and September meetings. You can see that was in stasis really from November through the beginning of this month, which was the reason, I would argue, that we had the risk rally that we've had over exactly that period of time. Because the markets thought the tightening was done, that effectively they could see the end and could begin to anticipate the rebound in risk. Notice that through that period, and especially into the latter half of it, December, January, the Australian dollar has a strong rally. The moment that at the beginning of this month, that narrative breaks down and we see an upshift in expectations for where the peak rate for the Fed is going to be, the Aussie collapses. And it collapses clearly not because there's a Chinese rebound that's gaining momentum, as the evidence shows. That would be Aussie dollar supportive. Clearly not because there's been a hawkish shift in RBA policy expectations. That's supportive. If those were the catalysts, Aussie dollar should be going up, not down. And yet very clearly, this is not the case. What this tells us, crucially, is how much the market cares about these other catalysts and how much it cares about the Fed. It doesn't care about the reopening in China, at least not yet. It doesn't care about everything that follows on from it, which is perhaps a pickup in commodities demand, perhaps better fortunes for commodity producers, perhaps more inflation there as a consequence, perhaps a more hawkish posture from the local central bank as a consequence. That's not what we're looking at. We're looking at a market that is looking through all of this and is focusing on the cost of capital, that is focusing on the Fed. And this is why this Australian dollar exchange rate is such a critical indicator, that it's falling as all these positive things are happening, seemingly, that should make it go up, tells you exactly where market sentiment is, and tells you also the path of least resistance for stocks. It signals this is not a confident market. This is not a market that thinks everything is okay. This is a market that's still very worried, and the thing it's worried about is more Fed tightening. So as we get more U.S. economic data warning that perhaps more of it is coming, that perhaps the Fed needs to hold rates higher and for longer, that's the story. And other things are just not what the market seems to care about. Tellingly, and now we're actually looking at the 6A Australian dollar future, we've constructed a really well-defined bearish head and shoulders setup here, which we have now confirmed with a break of its neckline around 68.60. And not surprisingly, there's continued extension. The pattern has essentially worked out as one might expect. Once we took that neckline out, we've had follow through on the downside. The pattern would imply, and this need not obviously happen exactly, right? Markets are not on autopilot. There's not a button that you press on this or that asset that says, oh, here's the Head and Shoulders button. When you press the button, the price goes from X to Y certainly and every time, right? That's not how this works. Nobody can tell the future. But usually, the way you would sort of benchmark where a Head and Shoulders breakdown would go is you would take the distance between the top of the head and the neckline and extrapolate that down from the neckline. And of course, if it were a bullish Head and Shoulders, you'd extrapolate up. But nevertheless, it would be the distance between the head, the peak of it, and the neckline. And here you can see the implication is, tellingly, that we're going back to about 65.30, 65.35, something like this. So from a technical perspective, this decline is not done, at least not yet. Now, maybe it will take that level out and keep going. Maybe it will stop sooner. Unclear. But what this is seemingly saying is the market will continue to care about the Fed. It will continue to ignore other catalysts. The bias then on everything risk correlated, cyclically sensitive commodities, stocks in the US and otherwise, anything that fundamentally relies on investors' appetite for risk, meme stocks, tech, all of these things that are at the riskier end of the spectrum, crypto, all of it still looks very vulnerable. Because if the Australian dollar is doing this, when it has solid local reasons to be doing the polar opposite of this, it is telling you where market sentiment is pointed, and it's not a positive direction. With that in mind, this makes for a very, very powerful indicator for gauging where things are heading. We, of course, have another powerful indicator that is the ISM manufacturing survey. That's coming up today, and we covered it on the show today. And somewhere here, there will be a link where you can access that video. I'm not sure if it'll appear on the right or the left, so somewhere to the side of me. The other link will be to the playlist, and it'll just be the video right before this one, so check that out for a preview of these ISM numbers. That does it for Micro Money here for today, though. If you want to follow my various thoughts outside of the show, we do overtime with our good friend Chris Vecchio, head of Futures and Forex, right before this show, Monday through Thursday every week. You can also catch me on Twitter at Ilya Spivak. Thank you very much for joining. We'll see you tomorrow. Happy trading. Take care.